I mean, you said it. We made it in to talk about this today because you don't often see a juggernaut like this move 8% to the downside.
This is a pretty big move for Disney, and I think you're seeing sort of the whole media sector is under a lot of pressure. And it's because the traditional, the core business of many of these media companies are broadcast and cable networks. And you're just seeing those businesses really, really struggle. I mean, cord cutting is accelerating. You're seeing that from all of the major players, whether that's Comcast or Charter. You've seen it with Dish. You're just seeing a real acceleration in cord cutting, meaning high single digits. You're seeing companies like Comcast have double-digit declines in their video subscriber businesses. That's having a real impact on companies like Disney. You saw it at Paramount last week with a huge move to the downside, and Paramount forced them to cut their dividend. All of these companies are struggling with what is the future. Because remember, streaming, they're losing money.
Yeah.
They're cutting the losses, as you just profiled, which is good, but their core businesses are facing more and more headwinds where revenues, both subscription revenue and advertising revenue, are going down, and their cost structures are going up, and their only choice is to massively cut costs. And that's what you're seeing across the board in media now.
Or indeed charge us more when we do get addicted to certain subscriptions. The overall view of Disney Plus is charge them for it or get good advertising.
I think Disney Plus is very similar to what you're seeing out of Warner Brothers Discovery, WBD. You're seeing similar strategies of both companies wanted to be Netflix. Like their goal was to take on and be Netflix, meaning a little bit of something for everyone. It was not just HBO within HBO Max, now called Max. I think with Disney, they were trying to be a little bit of everything, really broaden out the programming. And I think what you're seeing now is really a contraction back to what their core is. HBO is really centering back on HBO. Disney is sort of saying, we're going to cut $1.5 billion of content out of the pipeline as well as on the service itself. They just aren't equipped, really financially, to go compete at the level of what Netflix is trying to do globally. I think it's actually a very, very bullish sign for anyone looking at this space. You should be buying Netflix this morning. I mean, that is the clear takeaway, is that Netflix is increasingly, quote unquote, one.
Rich, consolidation of platforms, the combination of Hulu and Disney Plus. This is what Bob Iger had to say. There seems to be real value in having general entertainment combined with Disney Plus. And if ultimately Hulu is that solution, we're bullish about that. Are you bullish about that?
Well, it's really interesting, honestly, because, Ed, just a few months ago, Iger was talking about how general entertainment was undifferentiated, sort of calling into question the future of Hulu. They had retained an investment bank to look at selling Hulu. My guess is they couldn't find a buyer for Hulu, and they realized that they really have no choice other than to absorb it. And so I think, and they're also looking at Disney Plus slowing, and so they're looking at broadening the content out. But remember, what they announced last night is not really a combination of Disney Plus and Hulu. If you subscribe to both, you'll see a Hulu tile inside of Disney Plus. You won't even get all of the content that's on Hulu inside of that Disney Plus tile. You'll have to go to the Hulu app for all of the content. But it really, I think, the key trigger is this essentially is a sign to Wall Street and to the broader media industry. Disney knows they're going to be buying Hulu. It's probably going to cost them at a minimum $9 billion, but probably $10, 11, 12, or $13 billion to buy Comcast out of their Hulu stake. And I think that's also adding to the pressure on Disney stock because it's another financial burden that's coming over the course of the next 12 or 18 months.
Rich, our Star Wars fans out there in the audience will notice that going into May the 4th, there were in-platform and out-platform ads about all of the content that was coming relating to that May the 4th be with you date. Was that the shifting marketing costs that the CFO blamed a widening loss on?
I think one of the big questions for Disney, this is broader than just your question on Star Wars, a lot of the core franchises have not been firing on all cylinders. I mean, look, even Guardians of the Galaxy, very well reviewed. Third film is clearly doing worse than the second film. There is really questions, you saw it with Black Panther, like Disney's having trouble both in their sort of live action filmmaking with their major franchises, as well as animation. I mean, animation is probably the story no one's talking enough about. I mean, last night on the call, Bob Iger congratulated Universal, a competitor, on their animation success with Super Mario. The lifeblood of Disney is animation. And Ed, think about what was the last Disney animated movie that people were really excited about? It's been years now, and they're really getting beaten to the punch day after day by Universal. And I think it's a problem for Disney. And I think it's what Iger, I think more than anything, Iger is slowing down production, focusing on quality over quantity. So it's absolutely the right decision for Iger to do. The problem is it's not a quick fix. Last time when he came in originally to Disney, the very first time, what did he do? What was his quick fix? Was buying Pixar. There's no quick fix. It takes years to turn around animation and even just content more broadly. You don't just change your movie schedule overnight. And so this is, I think, sort of what you're seeing in terms of investors. Yes. They're becoming aware that the fix for Disney is going to take time.
Fantasia 1940, to answer your question. Caroline, what Disney faces is problems in common with the rest of the industry, one of them being a writer's strike in Hollywood.
Yeah, and to that end, costly labour at a time where they need people to be writing. Just, Rich, how much is that? Obviously, we're seeing overall people worrying about writer's strike, about the cost of labour, about trying to trim down. Is this something that affects Disney in particular, that we spoke about it on the...
Well, I think you should think about all of these companies are losing, leave off Netflix, which is making billions in, EBITDA and free cash flow. But all of the other legacy media companies, whether it's Disney or Paramount or Comcast, NBC, Universal, they're losing not a billion, they're losing billions on streaming. So anything that slows production is actually, in the short term, financially, on a cash basis, is actually good for them. Meaning they will lose less money this year because of a long writer's strike. That's sort of perverse, but that's essentially what's actually good for these companies on a cash basis. The problem is, and I think this is the obvious one, a long writer's strike clearly is going to impact linear television come the fall. You may not see a lot of your favorite shows on air because you need writers for these shows on linear TV. For people that are still watching linear TV, and yes, it's shrunk a lot, but it's still a pretty big business for these companies financially. And so that's going to have an impact. Plus, if the strike goes on long enough, meaning the fall, September, October, then you start to impact how much content is on these streaming services. And that could also be a problem for these companies in terms of keeping subscribers. You saw people who were clearly frustrated with Disney losing subscribers. Yeah. Not a big number in the US, but lost a little bit of their subscriber base last night. That's something they haven't sort of seen from Disney in the past.
There are more immediate headline-grabbing lines for us to focus on with Disney today, but AI did get its way in there a bit, and it feeds into the writer's strike and what they're worried about at the moment. Is AI in any way going to help hinder Disney, do you think? Is it something to be talking about?
Look, I think AI as a category is something that can help production. Obviously, there's ways that it can speed production. Certainly, if you think about what you can do with it creatively. I actually think for most of the media industry, I think AI is certainly a risk in the short term, not because of piracy. I actually think about what the greatest risk of AI right now is. Imagine the quality of content on YouTube, on TikTok, on Instagram Reels. The better that content, we're in a war for time. Yeah. If you think about everything as a war for time, if all of a sudden the content that some random person can create on their own and put up on TikTok or create their own newscast, whatever it may be, all of that creates competition for eyeballs. And I think when you're talking about advertising, you're already seeing the impact that things like Netflix are having on taking ad dollars away from traditional media. I mean, next week's the big TV up front. Now imagine the quality of sort of user-generated content getting meaningfully better.
Well, Rich.
That's what I'd be worried about.
Let's go back then to our question of the day, which is Disney a technology company or is it just simply a media and entertainment company? Very quickly.
I would say it's neither. Disney's an IP company. They're probably the best historically at creating IP and monetizing it through the flywheel of all of Disney's engines. The challenge is their IP hasn't been as good. And the reason you're seeing, look at what happened with their consumer products business last night, down dramatically year over year. I think the creative engines of Disney, not are bad. Certainly, I think a lot of other companies would love to have Disney struggles, right? Because their struggles are still better than a lot of other companies. But relative to where Disney's been over the last 5 years, certainly if you think about Iger's first run, where he sort of, went off into the sunset with this incredible run in 2019, Disney is certainly not firing at that level creatively that they were back in 19. And I think that's what investors are concerned about and looking for them to turn around.